Praveen sir, should we start with your
Okay,
permission?
yes,
तो start that.
Yes,
Okay, okay. So एक मिनट के लिए हम लोग स्क्रीन शेयरिंग ऑफ करें सर? Is it okay?
okay. Okay, sir.
Yes. Thank you, sir. Okay. Good afternoon, everybody. This is CA Piyush Chandak from Nashik, currently a treasurer in WIRC. And we are here meeting for the intensive course on accounting standards. The course which I discussed yesterday only with the chairman of the committee, Mr. Chintan Patel, and vice chairman CA Parikji, that the course has been designed for the purpose that this learning should be done in several parts. Daily, some parts to be learned with a different faculty. And during the buzz of Indias and IFRS, we are again trying to refresh and revisit the accounting standards to have a sound knowledge in the area of this particular area of practice. So I should thank today's faculty and also the coordinators, and I should congratulate again Rahul Parikji and Chintan Patelji for the beautiful design of the course. Now we have a wonderful faculty with us, CA Praveen Naga ji. He is a chartered financial accountant, CPFA from UK and chartered accountant from India. His partner in Navratan and Co LLP Chartered Accountants India. He has more than 11 years of experience in the wide spectrum of accounts assignments, including IFRS training and consulting, and external audits and MIS reporting. He is an international faculty on IFRS, having delivered lectures in India, UAE, Saudi Arabia, and Singapore. About his qualifications, he is member of Institute of Chartered Accountants of India from 2011, member of Chartered Institute of Public Financial Accountants from March 2020, certified fraud examiner from ACFE February 2020, qualified as diploma in IFRS from ACCA in 2011, and diploma in IPSAS from August 2019. So his domain of practice is IFRS and Ind AS and consulting of those. With this brief introduction, I'll request today's faculty, a wonderful faculty, to share his knowledge with us. Thank you. Thank you very much, sir, for joining.
Thank you, sir. Thank you very much. So yeah, if you permit, I can start now, right?
Sure, sir. Thanks a lot, sir.
Thank you. Okay. So I'm sharing my screen. And yeah, is it visible, sir?
Yes, sir. It is visible.
Okay, fine. So welcome to this intensive refresher course on practical aspects related to accounting standards. Today the topic will be mostly on assets related standard. So I like this idea of doing this intensive refresher course on accounting standard because we feel that even though right now if you look at listed company, they're following Ind AS, but in India we have almost 70 to 80% of SMEs, so they follow only accounting standard. So we should have thorough knowledge on accounting standard, and accounting standard is the basis for upgrading our knowledge to Ind AS or IFRS. So today my role would be to discuss about most on the practical aspects and also a little bit theory about all these standards related to assets. So the topics which I'm going to cover today is on accounting standard 2, valuation of inventories, 10, property, plant and equipment, 13 on investments, accounting for investments, and 26, intangible assets, and AS16, borrowing cost. So these are all general items which we deal on a regular basis in a company, whether it is manufacturing or trading company. So these are the items which normally you observe in the financial statements of a company. So we should be having a thorough knowledge on these standards. So first I'll start about AS2, valuation of inventories. I'll give just a brief overview of what happened with the standard. It was originally issued in 1981 as valuation of inventories based on then International Accounting Standard IAS2, valuation of inventories. This was revised in 2016 by MCA and also by ICI. So MCA is for companies. As you already know, companies they follow accounting standard issued by MCA, and for other entities ICI issues the standard. So in 2016 the standard was revised as part of aligning the standards with IFRS. So I see that if you are thorough with AS2, the same standard is applicable in IFRS or Ind AS. So we'll be easily able to understand that topic also. So what are the practical problems we face when we do accounting for inventories? Most of the time we face problems related to at what point of time should the item be measured, should be classified as inventories, or at what should be the cost, what should be the cost of these items. Okay, so at what point of time should items be included in inventories and what cost should be included? So sometimes we face dilemma in which cost should be considered, which cost should not be considered, and what are the cost flow assumptions we follow while measuring the inventories, and what should be the value when we prepare the financial statement, how much value we should present in the financial statement. These are the practical problems related to inventories when we deal with that accounting. So this all these problems are solved with the standard AS2. So first of all, what normally constitute inventories? I'm just giving a brief overview on this. So what items are considered as inventories in the financial statements? One, okay. Uh, So what items are considered as inventories? Inventories are those items which we hold them for sale, held for sale in the ordinary course of business. So most of the time we can consider this as finished goods, or if you are a trader, the item that you purchase and which is held for sale in your ordinary course of business are considered as inventory. So finished goods are goods held for sale or in the process of production for such sale. So the best example is work in progress. So if you're a manufacturing company, when you produce your goods, there are some items, some goods which are still in production. They are called work in progress. So they are also considered as inventories under the standard. And the raw materials, so in the form of materials or supplies. So when you purchase raw materials, they are considered as inventories. So this is generally about definition. So if you talk about the examples of inventories, we already know, like if you're a retailer, all the merchandise that is purchased by you and held for sale will be inventory. Or if the company is a computer software related company, so any software which they hold for sale, resale, will be considered as inventory only. If you're a real estate company, any land and property that you buy for resale will be considered as inventory. So if you're any other manufacturing company, all your finished goods, work in progress, and raw materials will be considered as inventories. I would like to stress upon this slide because what you see, the revision happened in 2016 in AS2. So most of that revision is related to this slide only. Earlier, spare parts and equipment were generally considered as inventories under AS2. But in rare cases, it used to be classified as fixed asset. But now AS2 is revised and it clarifies that if you hold any spare parts related to machinery or any servicing equipment or standby equipment, we should not classify them as inventories. We should consider applying AS2, sorry, AS10. We should consider applying them under property, plant, and equipment. So this is one revision happened in the standard. So when I deal with AS10, I'll stress upon this fact and we'll discuss more on this point. Then you already know inventories generally are measured at lower of cost or net realizable value. So what is cost? It is defined in the standard, and what is net realizable value? It is defined in the standard. We will just go through that. So cost normally consists of your cost of purchase or cost of conversion and other cost incurred in bringing the inventory to the present location and condition. It is, by looking at this definition, it is very simple. But when you apply practically, sometimes we face dilemma in what cost should be considered. First of all, I just discuss about cost of purchase. It is very simple. So cost of purchase normally consists of purchase price, the amount that you pay in purchasing the material. Then any duties and taxes, for example, import duties, which are not refundable by government authorities, will only be considered. If they are refundable, we'll not consider them as part of cost. Now we have GST. So GST is normally refundable. So we considered it as not a cost of inventory. Freight inwards, all your transportation cost in bringing the inventory. Then any other directly attributable expenses like loading and unloading costs, these are considered as cost of purchase. Then what about cost of conversion? See, if you're a trading company, most of the cost related to cost of purchase. But if you're a manufacturing company, then the significant cost could be cost of conversion. So you incur cost related to converting the raw material into finished goods. For that purpose, you might employ many people. So you pay all the labor or wages, salaries to the employees in converting them. So we consider that as a cost. So direct labor cost will be considered as cost of conversion. Apart from these costs, we incur other costs like overheads, indirect expenses, uh, like rent in a factory or electricity consumption. So all these will be considered as overheads. So we divide the overheads into fixed overheads and variable overheads. So we need to allocate the overheads to the cost of inventory, to each inventory. So how do we allocate? For that purpose, we need to classify them into fixed and variable. So what is a fixed variable? Fixed overheads. Fixed overheads generally are constant throughout the period, and variable overheads depend on the actual production. So when it comes to allocation of fixed overheads to inventory cost, we consider normal capacity as a basis, and we allocate the cost to the inventory. So what is normal capacity? It's a production expected to be reached on an average over a period of over a number of years. So I'll stress upon this in next slide. Then variable overheads, we allocate them based on actual capacity, so actual usage of production facilities. So variable overheads, it's very simple. We know how much cost we incurred, then we allocate per unit what is the cost per unit. But when it comes to fixed overheads, there will be some complex calculation which we need to do, that is based on normal capacity. So for normal capacity, uh, sometimes people get confused. So I've taken one opinion which is given by expert advisory committee of ICI. How do we calculate the normal capacity? So there was one opinion sought by a company, government company, how to calculate normal capacity. So in their company, they used to calculate average production of last 5 years for normal capacity, and they used to allocate that over the as the cost of inventory. So they sought the opinion of expert advisor company whether that based on past 5 years, whether it is right or wrong. Or can they take budgeted production as a basis for allocating normal capacity? So the expert advisory committee gave the opinion that you can consider average production based on past few years, 5 years or 6 years, whatever it is, provided it approximates the production expected to be achieved in the future period. So past data is one best guidance, but we may not be sure that we are going to follow the same practice in the last few years. So there may be some changes expected. So there may be some reduction in capacity, or there may be increase in capacity. So we have to consider what is our future production based on the environment, based on the facilities available. So if past capacity can approximate the future expectation, then you can consider that past capacity as a normal capacity, then you can allocate the cost. If not, you can consider budgeted production for the next 1 year or 2 years as the basis for allocation of fixed overheads. So this is the opinion given by the committee. So we can take this as a guidance and we can apply in practical aspects. When it comes to other costs, what are the other costs incurred by a company in measuring which can be considered in the valuation of inventory? So other costs generally are only considered if they're incurred in bringing the inventories to the present location and condition, such as overheads other than production overheads, or cost of designing products. Okay, so cost of designing products can also be considered as a basis for can also be considered as a cost for incurring cost for measuring the inventory. There are some costs which we cannot consider, them as cost of inventory, such as abnormal wastage. So if you in a manufacturing facility, sometimes we get some abnormal wastage because of some faulty material, or because of some mistake by employees, or because of some product from machinery problem. So if there's any abnormal amount of waste which is coming from the manufacturing process, we cannot consider the cost as a cost of inventory. Then for storage cost, so if you incur any storage cost, generally storage cost are not considered as a cost of inventory. But if the storage cost is necessary in the production process prior to further stage, for example, storage cost incurred for raw material will be considered as a cost of inventory, but storage cost of finished goods will not be considered as cost of inventory. Then administration overheads, so like general overheads, like if any other than production facility employees employed in administration capacity, if they are not, or management cost, so all these will be considered administrative overheads. So if they're not involved in bringing the inventories to the present location and condition, if they're not related to factory, we will not consider administrative overheads. Then finally, selling and distribution cost, we cannot consider them because these are related to after production and after finished goods produced, we sell them. So marketing cost, all those will not be considered as a cost of inventory. There is again one more guidance given by expert advisory company. There is some oil company in India. They are paying royalty to government for extraction of oil. So they got a license from government to extract oil on petrol or natural gas. So they are paying as per the government contract with the government. For every units which they produce, they have to pay some royalty based on some fixed calculation. So it doesn't matter whether they sell this product or not. When they extract the oil, they must pay royalty. So there was a query from this company whether this royalty should also be considered as a cost of inventory or not. So they were seeking guidance whether this should be considered as a cost incurred in bringing the inventory to present location and condition. And there was a query from auditor that this should not be considered. But this company went to expert advisory company, and this committee gave reply that royalty payable by oil companies, they are necessarily related to bringing the inventory to present location and condition. So you must calculate the royalty and as the cost of inventory. Don't show it as an expense in P&L. You calculate this as a cost of inventory. So this is the opinion. You can relate this opinion to any other royalty payable by any company in other industries. So if any royalty is payable on production capacity, we must consider them as a cost of inventory. Then there are special costs such as borrowing cost incurred or depreciation of property, plant and equipment. So borrowing cost generally considered as not a item, not a cost related to inventory, but unless the inventory is qualified as qualifying asset. So I'll deal with AS16 borrowing cost. So if the inventory can be considered as qualified asset, then you can consider borrowing cost. So in most of the cases, borrowing costs are generally not considered as a cost of inventory. So that is one point. Then depreciation of property, plant and equipment used. So as I already mentioned, they are considered as overheads. So they are included in the valuation of inventory. Then what about joint production process? In most of the companies, there may be one single process for manufacturing 2 or 3 products. So the raw material may be same, the production facility is same, but the end product will be 2 or 3 different products. So in that case, we need to allocate the cost of all the cost incurred towards these 3 products or 2 products. So how do we consider if there is any joint products? So AS2 says you should consider cost of conversion based on a reasonable basis. So you have to think what is the reasonable value for each of the item. So one of the best example for this is based on the relative standalone selling price at the time of separation. So once the joint products are separated, at that moment, if you want to sell them in the market, how much amount you will get by selling them. So standalone selling price at the time of separation will be considered as a basis of allocating the joint cost. So what is the difference between joint product and byproduct? In case of joint product, most of the value, all the, suppose in a joint product, joint process, you got two products. So each product will have significant value in relation to total cost. In case of byproduct, one product value will be negligible in comparison with other. So that is how we need to measure, we need to identify items as either joint cost or joint products or byproduct. If it is a byproduct, we don't allocate the cost to each of these items. We directly take the net realizable value of the byproduct and we deduct the net realizable value from the total cost, and whatever is the remaining value which will be significant, that will be allocated to the single original product. So for the best example is in case of sugar manufacturing, you get molasses. Molasses will be considered generally as a byproduct. So we take the market value of molasses from the total cost, we deduct that, and whatever is the remaining amount will be considered as the cost of sugar. When it comes to techniques of valuation, just a second. When it comes to technique of valuation, we use some different techniques. For example, if you find that inventory is not ordinarily interchangeable, means you go to a manufacturing facility, you generally find that they're using the process to produce one single item, or the items which are generally produced or not interchangeable. So means it's not a large scale manufacturing, it's a single product or two products in a day. So generally not interchangeable. Then we identify cost specifically. What are the costs incurred in bringing the item to the present location and condition? We identify the cost specifically and we allocate the cost. If manufacturing process results in inventory ordinarily interchangeable, that means today you come and look at the facility, you see some materials, finished products. So tomorrow if you come, you will find different batch. So that means it's a large scale manufacturing. In that scenario, it is very difficult to identify what are the costs incurred in bringing the inventory. So we follow either FIFO or weighted average method, which are called as historical cost method. We measure them under FIFO, first in first out, or we use weighted average cost. We take the total cost and we divide based on the number of units weighted average. If it's a first in first out, we calculate whatever is the inventory produced first, we allocate the cost toward that, and we assume whatever is sold will be the one which is manufactured first. So here AS2 prohibits LIFO, last in first out. We should not follow LIFO. But AS2 permits other two methods also, which are generally non-historical cost. These are based on estimated cost basis. One of this is the standard cost. So standard cost is also a permitted method, provided it approximates the actual cost, whatever cost you incurred in that year. If standard cost is followed, it should be almost equal to the actual cost. There should not be too much variation between actual cost and the standard cost. So standard cost is also one method which some companies follow. So where the production process is very strict and it's very quality basis, so they find that standards are most of the times is followed, then you can follow standard cost. Then there is another method permitted, which is retail price method. So retail price method is mostly applicable for those in retail industry. So where they take the retail selling price as a basis and they deduct the gross margin from the retail price and they arrive at the cost. which is nothing but a estimated cost. It's not the actual cost. So we can use standard cost or retail price method, provided the cost which you are calculating is equal to the actual cost, is approximating the actual cost. Otherwise, we cannot do that. Then let me discuss about net realizable value. So we already know that inventories are generally measured at cost or net realizable value, whichever is lower. So what is the basis for calculating net realizable value? What is the presumption, or what is the triggering point? At what point of time we have to measure at net realizable value? Generally, standard mentioned that at the end of financial year, on the date of balance sheet date, you need to consider net realizable value and compare with the cost. If cost is less, fine. If net realizable value is less than cost, you calculate the loss and book it as a loss in that particular year. So AS2 follows Prudence Principle. So we estimate the future loss. So once you sell the product, you might get actual loss. But today, even if you're not sold the product, we estimate the loss based on calculating the estimated selling price. Then we book that loss today. So AS2 follows Prudence Principle. But what is the general triggering point? You need not wait till the balance sheet date to calculate NRV. There are some triggering points, like if inventories are damaged, then the cost may not be recoverable. The value may not be, whatever you incurred on the inventory may not be recoverable. Then you have to measure the net realizable value. Or if you feel that inventory becomes obsolete, either fully or partially obsolete. So if it is fully obsolete, that means there is no market value for this product. Then you have to book the loss of 100%. Or if you feel that the selling prices in the market have declined in such a way that they are below the cost, that time you have to measure the inventories at net realizable value. Or if you feel the estimated cost of completion or estimated cost necessary to make the sale have increased. You know the selling price, you are estimating that selling price is above the cost, but to sell that product in the market, you need to incur some cost, estimated cost to make the sale, or you need to incur some further production cost. If those costs are increased, estimated costs are increased, so that your net realizable value is less than cost, then you have to measure the inventory at net realizable value only. So these are the triggering points, which we consider this as a general outside parlance. Inventories are impaired when these conditions are satisfied. Even without these conditions, as per the standard, we have to measure the inventory at cost or net realizable value, whichever is lower. So how do we calculate the net realizable value? We calculate the net realizable value based on the estimated selling price. So what is the basis for estimated selling price? So estimates are based on the most reliable evidence available. So we can take the, suppose on the date of balance sheet, immediately after balance sheet date is March 31st. Then on 1st April or 2nd April, we sold some goods. So we know the price of this. So we can take that as a basis, as a net realizable value, as a market price, and we reduce the estimated cost of completion on estimated cost to make the sale. Then we arrive at the net realizable value. So the standard permits considering the after balance sheet events. So once the balance sheet is prepared till the date of signing, you need to consider whatever events happening in the market, in the economy. Based on that, you calculate net realizable value. And also, net realizable value is calculated based on the purpose of holding the inventory. So what is the purpose that you are holding the inventory? So if you have entered into any firm contract, that means contract you have entered into, suppose you have 10,000 goods. Out of that 5,000 goods, you have committed to sell to a person, to a company, to an entity. So you have entered into contract, you cannot cancel the contract, you must sell them. So there is a price fixed in the contract. So NRV will be based on the fixed on that contract price for those quantity which you are holding. So out of 10,000, 5,000 you have committed to sell. So you take the 5,000 from the contract price and calculate NRV for those. For the remaining items, we calculate the market price. What about net realizable value for raw materials? So the standard says not only for finished goods, you have to calculate net realizable value for raw material as well. So for raw materials, the triggering point is the finished good selling price. So we have to calculate what is the sale price of finished goods. If you feel that finished goods are sold above cost, that means the market price of finished goods is more than the cost. That means finished goods are not impaired. That also means raw materials also not impaired. We measure the raw materials at cost only. So whatever is the cost that you incur in purchasing the raw material, we take that as a basis and we value the raw material. If you feel the finished goods are sold the below cost, that means the market price for finished goods with which these raw materials are used will be less than the cost, estimated cost. Then we measure the raw materials at cost or net realizable value. Whenever you are calculating net realizable value for raw materials, AS2 says the replacement cost is the best estimation. So you don't have to calculate the market price for the raw material. You take the replacement cost. So what is replacement cost? If you're buying a similar material from the market, what is the cost that you are going to pay? What is the amount that you are going to pay? That is the replacement cost. So for raw materials, we consider replacement cost as a basis for NRV. For finished goods and work in progress, we take the market price and we estimate the further processing cost and cost to completion. So this is how we calculate net realizable value for raw materials. Then what about some entities which are dealing in some businesses? There are some exclusion from AS2. So the standard is not applicable for those companies. So if you have any work in progress arising under construction contract, then we don't follow AS2 for measuring the cost. We go as per AS7 for construction contracts. In case of service providers also, for work in progress only, we don't calculate as per this standard. It is as per AS9 or AS9. If you're a company or entity which deals with stocks, shares, debentures, or any other financial instrument, that means you buy them daily and sell them. So you hold whatever shares, debentures as a stock in trade. So then AS2 is generally not applicable. So, but still entities dealing in those businesses follow some of the principles. So there is no clear-cut principle, guiding principle for these entities. They follow generally either at cost or market price, whichever is lower. That is a standard industry practice, but it is not coming from AS2. It is general industry practice. And also, if you're a company dealing with, if your entity dealing with agriculture related business, so you produce inventories of livestock like cow, buffalo, or chicken. So, or if you deal with any agriculture products, so you do the agriculture business, you are the producer, you're producing agriculture products or forest products or mineral oils. Then as per the industry practice, AS2 is not applicable. People measured them directly under net realizable value. So they don't calculate the cost as a basis. They directly measure them at net realizable value. That is the standard industry practice. We have in India, we have a standard dealing with agriculture related items. If you are in agriculture, then you have to follow IS India is 41 agriculture. But in AS, we don't have any standard covering agriculture. ICI is in the process of developing a standard on agriculture related business, but right now there's no principle available. So people generally follow net realizable value as the standard measure, irrespective of whether the net realizable value is more than cost or less than cost. They always follow net realizable value. So this is one practical example which we can take. Then when it comes to disclosures, how do we disclose them in the financials? As per AS2, it says you have to disclose your accounting policy. So what is the policy, cost or net realizable value, whichever is lower? Then what is the cost formula used, whether you are measuring them under FIFO or weighted average or standard cost or retail price method? So what is the total cost of inventories in the financials and the classification appropriate to the enterprise. So classification, generally people follow this classification. This is given in AS2, raw materials and components, how much amount you have in raw material components, then work in progress, finished goods, or if you're a dealer, if you're a trading company, stock in trade, how much you hold in stock in trade, stores and spares if they're classified as inventory, loose tools and others. Any other item apart from this? So earlier there is not much, this much list is not there in AS2. In Companies Act we have similar list, so AS2 is updated with this. So if you go to Schedule 3 of Companies Act, the classification is same as given in AS2 as per even Companies Act. If you follow AS2 disclosures, it is equal to Schedule 3 disclosures also. Same classification is provided in the Companies Act Schedule 3. Apart from this, Schedule 3 also asks company to disclose what is, if there is any goods in transit. So it should be disclosed under the relevant head. Then mode of valuation, which is nothing but cost or neutralizable value. So this is all related to AS2 valuation of inventories. So I dealt with some practical aspects, so we can use this day to day on a, we encounter some other problems on a day to day basis. So if you have any doubt on this, you can send a chat, then we can discuss at the end of the session any particular practical problems faced by you. So that's related to AS2. Then I'm talking about AS10. So the link between AS2 and AS10 is both are assets held by a company, but AS2 related to inventory. So inventory is generally held for sale. When it comes to AS10, if you hold any asset for not for sale but for production of inventories, then we classify them as PPE. So AS10 is one important standard which we should learn. So I'll also just give a background of the history about the standard. Earlier we had two standards covering accounting for fixed asset. One is AS6 depreciation accounting issued in 1982, then AS10 accounting for fixed assets issued in 1985. Later on, what happened? We followed Ind AS, we implemented Ind AS. So to make it AS10 and AS6 in line with Ind AS, ICAI revised the standard, and in 2016, MCA issued for the companies, and for other than companies, ICAI issued the standard. So we have only one single standard covering both depreciation and accounting for fixed asset, which is AS10. Now we don't call this standard as a fixed asset standard, we call it as a property, plant and equipment. So this is as per IFRS. So AS10 property, plant and equipment. So if you follow AS10, it is as good as following standard from IFRS or Ind AS. They are almost 100% aligned. In fact, AS10 is more advanced than the IAS standard because we have taken many other points also into consideration. Okay, fine. Coming to practical issues faced by companies when it comes to accounting for property, plant and equipment is when to recognize this as an asset in books, or how to calculate the carrying amount of this property, plant and equipment, then how to measure depreciation. So I'll cover that practical issues through this standard. Scope. This standard AS10 is not applicable for biological assets. We have separate slide covering on biological assets, so I'll focus on that. So as of now, you consider it as an agriculture related asset. So if you have any agriculture related assets, then they're not property, plant and equipment. We have to deal them separately. Other than bearer plant. So AS10 is applicable for bearer plants. I'll define what is that. Apart from this, if you have any wasting assets such as mineral rights, expenditure on the exploration for an extraction of minerals, for oil and natural gas, AS10 is not applicable for these assets. These industries follow general principles, not as per this standard. Okay, so we come to the definition of PPE. So what is the definition? So if you have any items which are tangible in nature, that means we can see them, we can touch them. So any tangible items which are held for use in the production or supply of goods or services, or for rental to others, or for administrative purposes. So if you have any machinery, the machinery which is used for production of goods will be considered as a PPE. Or if the machinery is used for supply of goods or services, supply of services, then we consider that as a PPE. If you have any item which is held for rental to others, for example, you have a vehicle which is given for rental basis, so then we consider that vehicle as a PPE. Or if you hold any asset for administrative purposes, like computers, so they're held for administrative purposes, we consider them as PPE. But one important thing is you should be expected to use them for more than one period. It's not just restricted to 1 year. Should be used for more than 1 year. Then only we consider them as PPE. If it is generally less than 1 year, we consider it as an inventory. So this is the difference between inventory. Inventory is just generally or held for sale. Means they are used for less than 1 year. But if you have any item which is used for more than 1 year, then we consider them as PPE. So the best examples are land and buildings. We use them for more than 1 year in production of goods or services. Machinery, ships or aircraft, motor vehicles, furniture and fixtures, office equipment, and bearer plans. So even bearer plans is also property, plant and equipment. Now let's talk about the spare parts which I mentioned in AS2. So if you have any item which are considered as the spare parts related to machinery, spare parts, so we generally use them as a spare. So if there is any replacement to be done in a machinery, we use these parts to replace the items. So the usage of the spare parts are not regular, it is irregular. We might use them for more than 1 year only most of the time. So then we consider these spare parts as a PP, not as an inventory. So what is the difference? If you consider them as inventory, we measure them at cost or net realized value, whichever is lower. But if you consider them as a PPE, you have to calculate depreciation. So that is the basis here. So apart from spare parts, you might be having another equipment called servicing equipment. So you might have some item which is used for repairing the machinery, servicing equipment. The usage of that item is also irregular. Then standby equipment. So for example, if you buy two machinery, you are using only one machinery for production. Another machinery you are holding as a standby. That means if there is any problem with the main machinery, I use the standby equipment. So standby equipment generally not used regularly. Even then, we classify them as a PPE under the standard. We account them as a PPE and we calculate the cost and then we account for depreciation. So this is the revision which happened in AS2 versus AS10. So now all the spare parts we classified them. So for this purpose, you need to take the definition only. So spare parts are held for use in the production of goods or supply of services, expected to be used during more than 1 year. So this is the distinction between inventory. So if spare parts are expect to be used less than 1 year, then we generally consider them as an inventory. So if you use them for more than 1 year, that means you find the irregular usage of spare parts, then we classify them as PPE only, not as an inventory. That is what you need to remember. Then the important point is when to consider an item of PP in the financial statements, or when do we recognize them in the books. So we recognize them in the books when you feel that the cost of PP should be recognized if it is probable that the future economic benefits associated with the item will flow to the entity and the cost can be measured reliably. So what is this thing? So when you purchase a machinery or when you construct a machinery on your own, you incur some cost. That cost should be classified as an asset only if it is probable that future economic benefits associated with this asset will flow to the entity. So what do you mean by this? Only when you feel that there will be benefits from coming to the company, to the entity by using this asset. That means you get future cash flows by using, suppose you bought machinery, by using the machinery you produce goods, that goods will be sold, then you get debtors will pay as cash. So there will be future economic benefits in the form of cash, and that whatever cost that you incurred can be measured reliably, then only you can recognize it, whatever cost you incurred. So cost most of the time is very clear. When you purchase the item, cost will be clear, but if you construct it on your own, then there may be difficult. So you have to estimate the cost. So only when these two conditions are satisfied, you recognize them. If one of these condition cannot be satisfied, you cannot consider that cost as a asset. Then you have to recognize that cost as the expense in P&L. So that is the principle related to recognition. So how do you identify cost? What is cost? So cost is the amount of cash paid. So if you're purchasing an asset, the cash that is paid in for purchasing the asset, or if you exchange an asset with another asset, suppose you're buying a machinery, new machinery, by giving up your old machinery plus cash you might pay. So the cost of the new machinery will be the fair value of the old machinery which is given up. Or sometimes you issue shares and buy PP, buy property, plant and equipment. So the cost of this PP is the fair value of shares issued. We have right now in AS, we don't have any standard dealing with this kind of shares issued. But in IFRS, we have, or in AS, we have 102 share-based payment. So if you issue shares for buying any asset, then we take the value as per that standard. Right now, you can consider that whatever shares that you issue, the fair value of that shares will be the cost of the PP. So if you purchase the items from outside, what is the cost? The purchase price that you pay is the cost. You pay in cash, so that is the cost. Or if you can give in any other consideration, the fair value of the consideration is the cost. But you also incur sometimes cost directly attributable to bringing the asset to the present location and condition. And also sometimes you estimate some kind of cost, like cost of dismantling. Cost of dismantling and removing the item and restoring the site on which it is located. So initial estimate of cost of dismantling. So this is mostly applicable for those industries in like energy industry, like nuclear production industries. So in case of nuclear company, they produce electricity by taking power from nuclear products like radium. So what happens in that case, the government might say you generate electricity in this facility for say 50 years. After 50 years, you have to vacate the premises, you have to clean the land, you have to restore the land as it is when it is handed over to you. So we incur some kind of dismantling cost. So those dismantling cost will be incurred in future. So but what the standard is saying, you have to estimate the dismantling cost today and make a provision for the dismantling cost. So create a provision, credit provision, debit, add to the cost of the item. So this happens in few industries, like these industries, like nuclear production industries or any other some dealing with energy or any other supply industries. So there you might be having some condition from the government. So in those cases, you have to consider the cost of dismantling cost also as the cost of PPE. Okay. When it comes to directly attributable cost, so what do you mean by directly attributable cost? So just now mentioned the cost directly attributable to bringing the asset to the location and condition necessary for it to be capable of operating in the manner intended by management. So what are those costs? So when you're purchasing an item, you might bring the item to the your factory site. So there will be cost of traveling cost, transportation cost. You might employ some people, so they will do some loading or unloading cost, or there will be some site erection, so you have to do some erection, site preparation, initial delivery and handling cost, assembly cost, even testing costs, whether the asset is as per the quality mentioned in the agreement, as per our intention, whether it is able to create production or not. Then any professional fees, any technical fees paid to consultants related to the acquisition will also be considered as directly attributable cost. We need to add this cost to the cost of the assets. Okay, then when it comes to exclusion of cost, what cost we should not consider in the cost of PPE? So any cost incurred in opening a new facility, or cost of introducing a new product or service, like advertisement cost, which we cannot consider these costs as a cost of PP. We need to consider them as an expenditure in P&L. Then cost of conducting business in a new location or with a new class of customer, including staff training. So if you incur any transportation cost from shifting one manufacturing facility to another facility, so you are shifting your entire production facility, so whatever cost you incur, you cannot consider them as a cost of PP. You have to consider them as an expense only. Or if you incur any administration cost, general overhead cost, you cannot consider them as cost of PP. You have to write out, or you have to consider them as expense only. Also, there are some costs incurred by you. Sorry. So cost incurred while an item capable of operating in the manner intended by management has yet to be brought into use. So you bought a machinery that is actually readily available for production, but your intention is to not to produce inventory at that particular uh, capacity. You want to increase the capacity, or you want to do some modification in the asset. So the asset is ready, but it is not ready for the management as intended by management. So management might not be intending in that manner. They want to intend it for another manner. So then what will happen? They'll incur further cost, like cost of changing some modifications in that, doing some modification in that asset, or some engineering cost, some professional cost they incur in modifying that. So all those costs will be considered as a cost for the all those costs will be considered. But if the management once management decides that the asset is ready for use, so asset is ready for use in the manner intended by management, but the item is not yet used, so we can call it as generally we call it as put to use. So item is ready for use as intended by management. So the important point is intended by management. If management intention is different and the asset is in different condition, then whatever cost that you incur should be considered as a cost. But if management feels that the asset is ready for use as intended by management, but still it is not used, so if you incur any cost after that, before the production takes place, it is ready for use, but there is a time gap between before put to use. So any cost incurred in this time gap should not be considered as the cost of PPE. So you might be incurring some production cost, you might be incurring some maintenance cost. These costs cannot be considered as the cost of PPE. We should consider them as expense only. Then there are initial operating losses. So you are starting a new product. So you've bought a PPE, you install the PPE, you install the machinery. So you are testing the item, or you tested the item, but you're not doing a large scale manufacturing, you're just doing some small scale manufacturing. So the asset is ready for use, you're using that asset, but you're using only in small capacity to build the output, to build the demand for the product. So you are doing in a normal small capacity, so you might be incurring huge losses, in initial operating losses. So those initial operating losses cannot be considered as the cost of PPE. So there is a deviation from previous standard. In AS10 earlier, initial operating costs were classified as the cost, and we used to amortize it for over a period of 3 to 5 years. But now initial operating losses cannot be capitalized. We have to consider them as expense only. Then cost of relocating or reorganization part of an item is also not considered as a cost related to PPE. So these are some important points which we need to remember. So earlier AS10 were having some differences between these items and between these items. So now there is a change because in international standard also we are following the same principles. So I'm just repeating. So once management intention is done, so you purchase the item and it is ready in the manner intended by management. Any cost incurred after the manner which is intended by management will not be considered as the cost. You should write it off as an expense only. Also, if you incur any initial operating losses, you cannot consider as a cost. Okay. What about the subsequent cost? So far, we are talking about the cost incurred at the time of purchase, at the time of installation, at the time of construction. But what about the subsequent cost? Once you classify any item as an asset in the books, if you incur any further cost, how do we consider that as a cost or not? So for this purpose, standard define this. If you incur any cost for day-to-day servicing of an item, day-to-day servicing, day-to-day operations, if you incur any cost, they are considered generally as repairs and maintenance cost. You should not capitalize it. You treat it as expense only. So day-to-day maintenance expense. But if you incur any replacement cost, how do we consider that? So you just focus on this point also. Earlier in a earlier standard there was some difference. Now you need to remember this. Replacement cost can be considered as a asset. You add that replacement cost as a asset to the old cost, provided the recognition criteria is met. So what is the recognition criteria? I mentioned recognition criteria like this. So recognition criteria is the cost of an item of PPE should be recognized as an asset if it is probable that future economic benefits associated with the item will flow to the entity, and the cost can be measured reliably. So in case of replacement cost, if there is any future benefits expected from the replacement cost. So the best example is, suppose you have a big machine, its life is 10 years. There is some part which is significant. The part is say damaged or say some repair happened. So we are replacing that part with a new part. So when you replace that with a new part, this new part is giving some kind of benefit, because without replacement you cannot use the machinery. So because of this replacement, you can use that machinery, you can produce inventories, so that benefit is expected for more than 1 year, and the cost can be measured reliably. Then replacement cost are also considered as asset. So you add to the cost of the original asset. Then what about the previous cost? The machinery, the part which is replaced, you now added a new part, you remove the old part. So what the standard says, whenever you are replacing an item with another item, you add the cost of the new item and deduct the value of the old item. So earlier we used to do some calculation estimating if there is any increase in life of the asset, or if there is any increase in benefits from the asset, then only we used to capitalize. So most of the replacement costs were treated as expense. Now what we need to do, we simply add this to the cost of the asset because there is some benefit expected from the replacement. So add the replacement cost to the book value of the asset. You identify the value attributable to the part which is damaged, which is replaced. You remove that value from the books. That will be removed and considered as expense in P&L, not the replacement cost. Replacement cost will be considered as the cost of PPE. In the same manner, for some industries, we incur some inspection cost. So inspection costs are also sometimes treated in the nature of replacement cost. So this is specific to some industries. I'll give an example. In case of airline industry, so there is a mandatory inspection which should be performed on the airline for every 2 years or 3 years, depending on the rules and regulations. So what happens with these items? Inspection cost also should be capitalized. If without inspection cost, you cannot run the aircraft. Suppose if you've not done any inspection cost, as per the rules, if there is no inspection done, then you cannot use the aircraft. So this inspection is a very huge cost for those industries, for aircraft industry. So when each inspection is performed, the cost of inspection will be added to the book value of the asset. Then we depreciate it along with the overall asset value. If expected replacement, next replacement is within 3 years or 4 years, we calculate the replacement. We calculate this inspection as a having life of 3 years. So within 3 years, we depreciate this inspection, and further any inspection is done, we add that item also to the cost of the asset. So I'm just repeating again. Any major inspection cost which are done for a specific industry like aircraft industry. So without inspection, you cannot run the asset. You cannot use the asset. So this inspection is a major item for them. So any inspection cost incurred for doing the inspection will be added to the book value of the asset and will be depreciated till the further inspection is performed. So you estimate that further inspection will be done in 3 years or 4 years. Then you depreciate that inspection cost within that 3 years or 4 years. Suppose if the further inspection is done in, you estimated that the further inspection will be done in 4 years, you added this cost to the book value of asset, then you have done the depreciation for 3 years. At the end of third year, you realize that you have to do further inspection now itself, not at the end of fourth year. So when you do the further inspection, you add the further inspection cost to the book value of asset. Whatever is the remaining carrying amount of the previous inspection should be derecognized, should be removed. So any previous carrying amount should be removed from the value of the asset, if anything is left. So this is how we need to consider. So we generally capitalize replacement cost. We generally capitalize inspection cost if they are major inspection cost. Day-to-day servicing items are considered as expense only. So if I recall, what is the cost generally? If you purchase the asset, the cost that is paid, purchase price will be considered as a cost. But if you construct an asset on your own, sorry, so if you construct asset on your own, the cost will be the cost of material used plus cost of labor used plus any allocation of overheads. All this will be considered as a cost of asset. If you exchange an asset with another asset, the important point here is sorry, the important point here is whether commercial substance is present or not. If commercial substance is not present, then we don't consider this as an exchange. Just give me 2 minutes, 1 minute, 1 minute. Okay, so if you exchange any asset with another asset, one of the factor is whether any commercial substance is present or not. So what do you mean by commercial substance? The value of asset given up is different than the value of asset acquired. Then only commercial substance will be present. if you exchange equal asset with another asset, so the value of asset given is almost equal to the value of asset acquired, then we'll consider them as no commercial substance is present. So if commercial substance is present, then we treat the asset at, we measure the value of asset at fair value of the asset given up. So the cost of new asset is the fair value of asset given up. If that is not clearly visible or not clearly calculated, then we take the fair value of the asset acquired. Only in those rare circumstances, generally fair value of asset given up will be considered. If that is not clear, then we consider the fair value of asset acquired. Even that is also not available, then only we take the book value of the asset given up as the cost of the new asset. So I believe this kind of exchange generally do not happen, but this is what if in case we encounter any such exchange, then we have to consider this. Okay, so just now I mentioned about some initial operating losses. In the same manner, there are some special condition, some special cost incurred, like during the construction of an asset. Suppose you are constructing a factory building on a land. So the building takes, suppose assume that the building takes 2 years time. So during 1 month there is no construction is happening because of some economic factors, some climatic factors or some factors. You're not doing construction for 1 month. So the land is vacant. So you gave that land for some function, for some kind of function happening in that area. So you collected some rent for the function. So using the land for some function. So what will happen? You got some income. So whether we should consider that income as a reduction in the cost of the building, because during construction period itself we use some of the assets and we generated some income. So what AS10 says, any incidental operations related to construction, incidental operation, but not necessary to bringing the item to the location and condition. So any incidental, so because you're keeping that land as ideal, you're using it, or you you bought some material, you're not using that material, you don't want to use that material, you bought the wrong material, so you sold the material back, so you got some profit. So whether we should consider that as a reduction in the cost. So what standard is saying, any incidental operations you should not consider it as a reduction of the cost or add to the cost. You treat them as an expense only in P&L. During the construction period, you treat them as a expense to P&L. Also, there is some kind of deferred credit. Suppose you bought a machinery, but you're delaying the payment. As per the agreement, you want to pay in installments. So like hire purchase item. So if you purchase them on hire purchase, so whatever is the payment that you are going to do, you have to calculate the present value of the payments. Only the present value will be considered as a cost of the item. The remaining amount will be considered as the interest expense. So deferred credit will result in interest expense. Okay, so these are related to cost only. Now I am talking about the how to measure PP in the financials. So just now mentioned initial measurement is at cost, and we define what is cost. Subsequent measurement. So if you compare with earlier AS10 with this AS10, there is a difference now. Earlier we used to only follow cost model. Now we have two models available for us. We can select cost model or we can select revaluation model. So cost model is generally used in many industries. Now we have another model which is available. We can use that. So we'll explain what is cost model, how to calculate, use the cost model, and how to select revaluation model, how to calculate value under revaluation model. So in cost model, it is very simple. You calculate what is the cost on initial acquisition or construction. Then you calculate accumulated depreciation, you reduce that from the cost, or accumulated impairment. So whatever is the resulting value will be the book value in the books. And cost, we already explained about how to calculate cost. Then how to calculate depreciation? So depreciation is nothing but a systematic allocation of depreciable amount of asset over its useful life. I'll just repeat. I'll just focus on depreciation in the next slides. For impairment, we consider AS28. We have AS28. Today, it is not part of our discussion, so we're not focusing much on impairment. So impairment is, if you compare with depreciation, impairment is a sudden reduction in value of an asset. So in case of COVID times, people used to calculate impairment for machineries, for PPE. So that is one important point, but today we are not discussing that. So how do you calculate depreciation? So for calculating depreciation, we need two things: useful life and residual value. So first of all, we need to estimate the useful life. So useful life, how do we consider under AS10? So what the standard is saying, the useful life is the period over which an asset is expected to be available for use by an entity, or the number of production or similar units expected to be obtained from the asset by an entity. So you estimate how many years you want to use the asset. So see, for useful life, you need to remember two things: physical life and economic life. Physical life is the life for an asset, which generally is more in terms of, like, because physical life means the asset will remain like that, but whether it is useful or not, that we don't know. So what we call is, what we use in AS10 is not the physical life, we use useful life. So whether the asset is useful for production of goods or service or not, that is the one which we need to consider. So useful life is generally less than the physical life. We only focus on useful life. So useful life is the period over which asset is expected to be available for use by the entity. How many years you want to use the asset? After that, you might sell the asset or you might dismantle the asset. Sometimes you don't consider them based on the years, we consider them based on units, production units, how many units the asset will generate during its lifetime. So based on that units, we calculate the useful life. So the life will be based on the estimated usage of the asset, how many years or life units we want to use it, we use that. So for this purpose, we can use the reference in Schedule 2 of the Companies Act. Companies Act is given in Schedule 2 useful life of many assets. So we can use that as a reference. I'll talk about Schedule 2 also. One important point which we need to remember in AS10 is we need to review the useful life of assets every financial year. So during every financial year end, or during the financial year, every year, we need to review the life. And if you see, if there is any changes in the life, you need to apply that change. You need to apply that change as a change in accounting estimates. Suppose you estimate the life of the asset is 10 years on the date of purchase. After 2 years, you decided that the life will be only 6 years. Remaining life will be only 6 years. That means overall life is 8 years only. So whatever is the value at the end of the second year, we depreciate it for remaining 6 years. So you need to review the life every financial year. Okay, that is about useful life. Then what about residual value? To calculate depreciation, we need useful life, we need residual value also. So what is residual value? It is the estimated amount that an entity would currently obtain from the disposal of the asset after deducting the estimated cost of disposal. So what do you mean by this? Today if you want to use the asset, today if you want to sell the asset, you can compare with the suppose life of the asset is 10 years. Today you bought the asset. So to estimate the residual value, you need to take a asset which is 10 years old today. So compare the value of the asset. Take the value from that asset which is of 10 years old. So what the standard is saying, estimated amount current entity would currently obtain from the disposal of the asset after deducting the estimated cost of disposal if the asset were already of the age and the condition expected at the end of the useful life. So today you have a 10-year-old asset which you want to sell in the market. So what is the value that you get by selling in the market today? So estimate that amount based on the current conditions today and fix the residual value. So this residual value will be used as a basis for calculating depreciation. It will be estimated initially. The reference can be made to Schedule 2 of the Companies Act, and this will be reviewed every financial year. Every financial year we will review residual value. One second. So the residual value will be estimated initially, but it will be reviewed every financial year. If you feel there is a change in the residual value, you need to account that as a change in accounting estimate. So useful life you need to review every year, residual value you need to review every year. Okay. Then next important point is depreciation method. So you need to select a depreciation method. There is a change in the previous standard with this. The depreciation method earlier we used to select based on some pattern. Now the what AS10 is saying, you should reflect the pattern in which the future economic benefits are expected to be consumed by the enterprise. So depreciation method depreciation method will be based on the expected future economic benefits to be consumed by the entity. So you can use straight line method. So if you feel that whatever is the economic benefit generated from the asset will be used equally over the useful life of the asset, then we can use straight line method as a basis. If you feel the economic benefits that are generated from the assets or consumed by the entity initially more, later on you use less consumption, so you can select WDV method, written down value method. Or if you use the benefits based on the number of units, so you can select units method. So units method is also allowed method as per the AS10 revised. So the depreciation, the method which you are selecting is based on the expected usage of the asset or expected consumption of future economic benefits which are generated from the asset. Now if you recall, earlier we remember in previous AS10 or AS6, when you change the method of depreciation, we used to calculate retrospectively the depreciation. And if earlier you are following straight line method and you change the WDV method, we used to calculate the depreciation as per WDV method from the beginning of the asset, from the purchase of asset, and whatever is the value today, we will account that value in the books. But now there is a change. If you want to change the depreciation method, you can change it, provided if there is any change in the expected pattern in the future economic benefit. So you thought asset will generate benefits equally over the life, so you selected straight line method, but later on you felt that asset is giving more benefits in the initial years rather than the future years, so rather than later years, so you selected WDV. You thought WDV method is the more relevant method, so you can change from the straight line to WDV method. When you want to change the method, you take whatever is the carrying amount on the date of change, only apply the new method for the carrying amount on the date of change. Don't apply prospectively, don't apply retrospectively, don't go back to the beginning of the purchase of asset and calculate. Don't do that. Whatever is the book value on the date of change, take that cost, take that value and apply the new method. So it is very simple. Now changing method will be simple, but you cannot just like that change it unless you need to have supporting evidence. What is the evidence? The future economic benefits which you are expecting or changing from the asset. So for this purpose, what the standard is saying, you need to review depreciation method also every year. If there is any change in the pattern, you change the method. So this is what to be done. So you need to review useful life, you need to review residual value, you need to review depreciation method every financial year, then calculate the carrying amount, then calculate depreciation. So how do we calculate depreciation and when depreciation will start? So already mentioned, if the asset is ready for use, so that means asset is in the location and condition necessary for it to be capable of operating in the manner intended by management. then we start the depreciation even when we have not used the asset. So it is when the asset is ready for use, we calculate depreciation. We will stop the depreciation when the asset is retired from active use and held for disposal, or asset is sold. When the asset is sold, means derecognized, we stop the depreciation. And depreciation charge will be generally considered as a expense in profit and loss. Unless it is used to produce inventories, we calculate that cost in the value of inventory, or it is used to develop any asset, construct any asset, we calculate the depreciation as the cost of the asset. So this is what we need to do. Okay, coming to Schedule 2 of the Companies Act. Schedule 2 of the Companies Act talks about the how to estimate useful life, and it has given the indicated life of assets based on the nature of asset. It also mentioned about residual value. So I'm not giving a detailed disclosure of how many years for each asset. So I'm just giving a brief of Schedule 2. So Schedule 2 says the useful life of asset shall not be ordinarily different from the useful life specified in Part C. Schedule 2 is divided in Part A, Part B, Part C. Part C is related to life of assets. So generally, the life of the asset should be taken from this Part C, and the residual value of asset should not be more than 5% of the original cost. This is what is mentioned in the Companies Act. But if you want to adopt a different life as per Schedule 2, and the residual value also different, then you need to disclose in the financial statement that you are not following as per Schedule 2, and you need to justify the you need to provide justification. You cannot adopt a life and you can take it. You need to support it by technical advice. So you need to put some technical advisor. He has to give the life. He has to estimate the life of the asset. Then you take the life as per that. So why this is given like this? Because as per AS10, the method that you are selecting will be based on the useful life. The useful life will be based on the expected usage by the entity. Then residual value is based on initially you estimate the residual value. It need not be 5%. It can be 1%, it can be 0, or it can be 10% also. So the method that you are selecting will be based on the life, will be based on the pattern in which future benefits are generated. So Schedule 2 is saying if you adopt useful life and residual value different than what is mentioned in Schedule 2, you need to provide justification. So I have seen in some companies like Infosys where they follow different life than what is mentioned in the Companies Act. So they provide that justification by technical advice. Based on technical advice, they follow that. So this is related to depreciation. So in case of cost model, we calculate cost and we calculate depreciation, then we get the carrying amount. When you talk about revaluation model, this is the change in the standard. Earlier the revaluation model was not there. There was some mention about revaluation. You can do revaluation, occasional revaluation, but revaluation as the model is not given. Now we have an option. So it doesn't mean you apply the revaluation model for one asset. So any model that you are following should be applied to a group of similar assets like land or building. You need to apply cost model, revaluation model, or PP, or equipment, property, or machinery. You can follow cost model or revaluation model. Then vehicles, then plant. So you need to have separate classification. Based on the classification, you need to select a model. Most of the entities follow cost model. Now we have an option, we can select revaluation model. So for which assets we will generally consider revaluation model? It is applicable in case of assets when fair value can be measured reliably. So fair value means generally market price will be considered. So assets which have regular market outside active market mostly will be considered for revaluation models. For example, land or building. So I already mentioned you cannot select a single item for revaluation model. You have to take the entire class of PP. So land on buildings, machinery, vehicles. So entire class of PP for revaluation. You cannot do one land as a revaluation model, another land at cost model. If you select one land for cost for revaluation model, you have to apply all the lands at revaluation model only. So how do you calculate the book value from revaluation model? We calculate fair value. If there is any gap between previous fair value and this fair value, in between those period, we calculate the depreciation. So even under revaluation model, we will not stop depreciating it. We will depreciate the item because we are using that item. So depreciation will continue till next revaluation. When the next revaluation is done, we will take that revised revaluation as a basis for the new depreciation. So the standard is saying if you select revaluation model, you must do it regularly. So within a period of 1 year or 2 years. Sorry. Sorry. So revaluation to be made regularly. Okay. So how do you account for revaluation? So I've given this flow chart. When you do the revaluation for the first time, so today you purchase the asset, you select a revaluation model. So you selected revaluation for the first time. You measured the fair value. Suppose if you find that fair value is more than the cost or the carrying amount, so there is a gain for you. That gain will be credited to revaluation reserve under reserves. But if you find the fair value is less than the cost or carrying amount, there is a loss for you. That loss will be debited to P&L as expense. So first time revaluation, increase in value will go to revaluation reserve, decrease in value will go to profit and loss as an expense. Okay, that's about the first time. Second time, subsequently you have done the revaluation. Means earlier also you have done revaluation, today again you have done revaluation. So this is second time or third time. So what we need to do now, we need to compare, we need to check whether previous revaluation, whether there is any gain or not. Based on that, we account for that. So if you go to the last left and last, so previously there is an increase, now also there is an increase. That means previously we have credited revaluation reserve, now also increase, we will credit to revaluation reserve. That is simple. Previously there is a decrease. If you come to right side, previously there is a decrease, now also decrease. So previously you have done debited to profit and loss and expense, now also you need to debit to profit and loss as an expense. That is also simple. Now first time there is a increase in value, second time there is a decrease in value. What will happen? So first time you have done increase in value, of credited to revaluation reserve. Now there is a decrease in value of the asset. So to that extent of balance sheet revaluation reserve, we will reverse that gain in the reserve. Any further loss will be debited to P&L. Okay, first time you have done revaluation, there is a loss. So that means you have taken it to P&L as an expense. Now there is an increase in value. So to that extent of whatever you have debited to P&L in previous years, if there is any increase, we will reverse that effect in P&L itself as a gain. If there is any further gain, then we will create credit to revaluation reserve. So our subsequent accounting depends on the previously what we have done. If there's increase, revaluation reserve, decrease, P&L only. Only if there is an increase and decrease, that means some amount will go to revaluation reserve, remaining amount might go to P&L. Earlier decrease, now increase. So whatever decrease you have done, you have taken to P&L. Now there is increase in value of asset. You can reverse that to P&L as a gain. Any further gain will go to revaluation reserve. So this is what is given in revaluation model. So I believe a revaluation model is one option which is available, but so far I've seen many companies not exercising the option because it is not very simple, because revaluation model should be selected only for those assets for which there is an active market. For a machinery which is installed in factory and which is customized for your entity only, you fix that machinery, you install the machinery in your factory. So only you can use that asset. It doesn't have any market value or no active market is available. So for those machinery, it is very difficult to apply the revaluation model. We would follow cost model as a basis. So the best example will be mostly land and building. So land can be considered under revaluation model, or building can be considered revaluation model. Other assets, I doubt whether revaluation model can be applied or not. But still, there is an option you can select if you want. Like you have a vehicle, you can follow revaluation model because vehicles will have market price. So you can consider that. So what about revaluation reserve balance? Suppose you got a gain, you credited to revaluation reserve. And there is subsequently also there is increase in revaluation reserve only. So fine. So you have some revaluation reserve. How do we consider that revaluation reserve later on, subsequently? So when the asset is sold, you have a balance in revaluation reserve. You transfer directly to retained earnings. You transfer directly to general reserve or surplus in P&L surplus. So you transfer to retained earnings, or sometimes you can transfer the balance from revaluation reserve to retained earnings on the basis of usage of the asset. Suppose you have a building, the cost of the building is say 1 crore. The life of the building is say 10 years, assume that. Cost is 1 crore. After 2 years, you have done some revaluation, the value increased to 2 crores. So now the value is 2 crores. You still have 80 years left. At the end of the life, assume that value will be zero only. So most of the assets which are used by the entity till the end of their useful life. So at the end of the useful life, the value will be zero. That means whatever gain that you're getting today will be reversed in the form of increase in depreciation. So you will do increased depreciation. So that depreciation increase compared to previous depreciation includes some amount of revaluation. So you can either transfer the revaluation reserve balance when the asset is sold, or you can transfer based on the depreciation amount. Because this extra depreciation is going to P&L, that means you are getting some extra loss in the P&L. So what we need to do, we cannot transfer the revaluation reserve directly to P&L. That is prohibited. The standard says don't transfer revaluation reserve from revaluation reserve balance to P&L unless there is a decrease in value. Other than that, whatever is the balance in the revaluation reserve, you cannot transfer to P&L. You can only transfer to retained earnings, not to P&L. That transfer to retained earnings can be done in two times, either on when asset is sold or when the asset is used based on the extra depreciation. So whatever is the extra depreciation amount, that much will be considered as a realization. You transfer to retained earnings. See, the idea is when you're doing revaluation, if the fair value of the asset is increased, it's a gain for you, but that gain is not a realized gain, it's an unrealized gain. So when will this unrealized gain becomes actual realized? When you sell the asset, that moment it will become realized gain. Or when you use the asset also, some of the amount will be realized in the form of extra depreciation. That is also basis you can transfer, but don't transfer anything to P&L directly from revaluation reserve. So this is a change previous versus the previous revaluation. In AS10 also, their previous AS10 old standard, we have an option to measure the asset for revaluation, but that's not regular option. It's a one-time revaluation which you can do. So in that cases, it is mentioned that any extra depreciation will be whatever is the extra depreciation, the amount of revaluation reserve will be transferred to P&L. That was mentioned in the previous standard. Now that is prohibited. You cannot transfer anything from revaluation reserve to P&L. Okay. So the point of our discussion today, whether which model is better for an entity, for an asset, cost model or a revaluation model. So I want you to think about this. To what extent the revaluation model or the cost model provide the users of financial statements with the useful information? For example, one entity is following cost model, another entity is following revaluation model. So which policy gives more better information to the users? Whether cost model is relevant or revaluation model is relevant for the users. Which model is better? Whether there is any bias uh, done followed by the company by using revaluation model or cost model. So next question is, does the existence of accounting policy choice between the cost model and revaluation model affect the ability of an investor to choose between investment alternatives? So one company is following cost model and the company is following revaluation model. So as an investor, whether you want to invest in cost model, the company which is following cost model, or the company which is following revaluation model. So as an investor, how we feel about the information. So this is what we need to think ourselves, and there is no ready-made answer available for this. We can have a justification for revaluation model, we can have a justification for cost model, but this is the open debate. Okay. Whatever model you follow, when it comes to retirement, that means when the asset life is over, you need to remove that from the books. So if the asset is removed, retired from active use and still not disposed, it should be measured at the lower of whatever is the carrying amount and the net realizable value, just like inventory. So asset held for sale, it's a PP held for sale. That means you don't want to use the asset, you want to sell it because the life is over, you don't want to use it further. Now you are holding them for sale. In IFRS or Ind AS, we have separate standard for non-current asset held for sale. In AS, we don't have any standard, so this standard itself covers that point. So if you remove any asset from active use and held for disposal, you measure them at the lower of carrying amount or the net realizable value. So how do you calculate net realizable value? We can take the guidance from AS2. So any write down between carrying amount and the net realizable value will be treated as an expense, P&L. This is about the retirement. Okay. Then next I'll talk about the derecognition of a PPE. So derecognition means when will you remove the asset from the books, from the financial statements. So when you sell the asset, yes, automatically it will be derecognized. But when you feel there are no future economic benefits expected from the use or disposal, so you have an asset, you have a PPE, you feel that there will be no more economic benefits from the asset, no more benefits from using the asset, or if you want to sell also, there will be no value from the asset. So that moment you need to remove the asset from the books. That means the asset will be considered as impaired. If there is any carrying amount available, that carrying amount will be written off. So any gain or loss on derecognition will be transferred to P&L only. So once you remove the asset, if there is any revaluation reserve balance left in the reserves, to directly transfer that to retained earnings. That's I already mentioned on that point. So this is about derecognition. Okay. When it comes to disclosures given in AS10, we need to disclose what are the measurement bases used for the for determining the carrying amount. So which model you are following, whether you're following cost model or whether you're following revaluation model should be mentioned. Then depreciation methods used should also be mentioned. Then useful lives or the depreciation rates used should also be mentioned in the notes, in the disclosures. Then you need to give the gross carrying amount and the accumulated depreciation at the beginning and the end of the year. Then you need to give the reconciliation of what is the difference between the opening and closing balances, additions, deletions. So all these disclosures you need to give. So comprehensive disclosures list is given. So we need to follow that. This is from the standard. When it comes to Schedule 3, Schedule 3 has given the list of items where how do we classify the line item. So you can classify land separately, building separately, plant and equipment, furniture and fixtures, vehicles, office equipment, or bearer plants. So these are the general classification followed by a company. If you want to use any other classification like computers, you can show separately. So you can disclose that. Suppose if you've taken any asset on a lease and you're capitalizing that asset, you need to classify them under the relevant head. This is from Schedule 3. Okay. So I was mentioning in the beginning, this standard is not applicable for agriculture related assets. So now I'll focus on that. Right now we don't have any standard dealing with agriculture. ICS is in the process of developing that. But if you follow Ind AS, there is a standard on agriculture. So most of this guidance is taken from that only. Even in AS10, if you read the plain standard, we have some mention about these points. So if you are dealing in agriculture activities, that means you are dealing in biological transformation of agriculture assets, biological assets. So what do you mean by agriculture activity? Management by an enterprise of biological transformation and harvest of biological assets for sale or for conversion into agriculture produce or into additional biological assets. So you take an example, say you have a plant, a small plant, you have sowed the seeds. Now the plant is growing into a big tree. So what is happening here is plant is getting biologically transmitted. So small plant is converting into a big tree. It doesn't happen over time, overnight. It will take a lot of years. In some cases it will be 1 year or 2 years, some cases it will be 10 years. So for doing this transformation, you are doing some activity. So management by enterprise of biological transformation. For example, you have a buffalo. The buffalo is giving calf. So that biological transformation is done by you. So you are involved in agriculture activity. So any assets used in this agriculture activity will be considered like a either PPE or biological asset. So suppose you have buffalo. That buffalo is a living animal. So it's a biological asset. You have a tree. Tree is also living animal, living plant. So it's also biological asset. So if you are having biological assets like living animal or plant, from that biological assets, you are getting some agriculture produce. From that biological asset, you are getting agriculture produce. Then you cannot follow AS10 for these assets. You have to follow general principles. But if you have a bearer plant, so you have a plant, a big tree, which is used for agriculture produce. So that tree produces some fruits or some wood or something. But the plant itself is generally not sold. It doesn't have any market, and it can only be used for giving produce. Once the produce is done, the plant will not have any much life, much value. So in case of bearer plant, we follow them as PP only. We generally consider them as PP only. We don't consider this as a biological asset. So all bearer plants will be considered as PP only, except bearer plants. If you deal with any other biological assets, it is out of the scope of AS10. So for more guidance, you can refer to Ind AS 41 for agriculture related assets. Okay, so this is related to AS10 property, plant and equipment. Now we will go into further standard, which is AS13 accounting for investments. So if you compare the type of assets related to investment, so compare with the PP. So PP is the asset held for use in the production or supply of goods or services. If you have inventory, they are held for sale. So what do you mean by investments? So we'll cover that. So if you have investment, how do we account for the value? How do we account for those investments in the books? So this standard doesn't talk about how do we recognize interest income or dividend income from the investments or rental income. We go by AS9 for this. So for recognition of income related to investments, we go by AS9. If you're operating lease or finance lease, then we don't follow this standard. We'll take the class measurement as per operating lease or finance lease. If you're an entity dealing with retirement benefit plan, so you have like a provident fund or some retirement benefit plan, you are an entity holding that plan. then this standard is not applicable. Or if you are a mutual fund also or any fund house, this standard is not applicable for that. We have separate regulatory guidance available for this. So what do you mean by investments? Investments are assets held by entity for earning income by way of dividends, interest, and rentals, for capital appreciation or for other benefits to the investing enterprise. So if you have any asset which gives income, which generates income by way of dividend. So what is best example here? If you invest in equity shares of a company, that equity shares can give you dividend income. If you invest in bonds of a company, that will give you income in the form of interest. If you invest in land or building which is given for rentals to others, that land or building will give you rental income. So even land or building also will be considered as an investment only. If you have any asset which earns income by way of dividend or interest or rental, or for capital appreciation, or for other benefits, sometimes we hold some investments for getting some kind of benefits which doesn't generate any income per se, but we still show them as investment, like investment in subsidiary or investment in any associates. May not be creating any income for you, but for the benefit of your business you are doing some investment, so those investments also considered as investments. But if you have any assets held as stock in trade, they are not investments. So many entities deal in purchasing and sale of investments regularly, so for them it is like a inventory. So when you have any shares and debentures held as a stock in trade, this standard is not applicable. But I'll come back to this point. There is some classification in the standard related to AS13 for current investments, so you can consider those stock in trade as current investment. So though this is not directly applicable, but we follow that. So I'll focus on this during the later part of the discussion. Okay, so what are the examples for investments? Investment property. So when you invest in land and building of any, when you invest in any land and building which generates income in the form of rentals or capital appreciation, we don't classify them as PPE, we classify them as investment only. If you have investment in equity shares, preference share, government bonds, or private bond, private debentures, private company, public company debentures, or mutual, if you invest in mutual funds, all those will be considered as investments. So the best part of the standard, if you have investment, you need to classify them as current investment or long-term investment, which we already know, but I'm just giving a brief. So if you have any investment that is readily realizable and it is intended to be held for not more than 1 year, see, your intention is to not to sell, not to deal in stock in trade, not to deal in purchase and sale of shares regularly every day. You're not a commodity broker, you're not a share trader, you're not a share trader, but you have some kind of investment which are readily available, for readily realizable. If you want to sell immediately, you will get money, but your intention is less to sell them near future, within less than 1 year, then we need to classify them as a current investment. For example, investment in equity shares or preference shares or bonds or debenture. What about long-term investment other than current investment? So if you want to hold any investment for more than 1 year from the date of purchase, then it will be considered as long-term investment. Just note this point. We'll come back on this point related to Schedule 3 classification. How do we classify investments under Schedule 3? The date of investment is very important. So from the date of investment, today if you have purchased, your intention is to realize cash within 1 year, then it's a current investment. Your intention is to not realize cash within 1 year, you want to hold them for more than 1 year, then it's a long-term investment. So investment property obviously will be considered as long-term investment only, because if you classify investment property less than 1 year, that means it will not be an investment, it will be inventory. So if you are dealing in land and building, your intention is to not to sell them but not to use them for the business also, only for earning rentals or capital appreciation, then we classify that investment property as a long-term investment. This classification is very important for measurement of investment because current investments are measured at lower of cost or fair value, whereas long-term investment mostly are measured at cost. There is a basic difference between these two. In current investment, we measure them at cost or fair value, whichever is lower. So what is fair value? I'll talk about it. What is cost? I'll come back. I'll talk about it. Generally, market value is considered as best evidence of fair value. Okay, so first we need to identify what is the cost of investment, whether it is short term, whether it is current investment or long term investment. You need to identify the cost. So if you purchase an investment, the amount that is paid, purchase price, if you pay any taxes, non-refundable taxes, sometimes there will be some transportation charges. Now if you deal in a demat account, there will be no physical security delivered, so you incur some brokerage cost, other cost. Okay, so all these are considered as cost. If you deal with any investment which is having already accrued dividend or accrued interest, so when you purchase any investment with accrued interest, so whatever amount you pay for the cost, which it also includes some interest element, so interest element, pre-acquisition accrued interest or dividend will also be part of cost only. Now tomorrow you get that interest from the company, or you get the dividend from the company, it will not be considered as the income, it will be considered as a reduction in the cost. So any pre-acquisition interest or dividend will be considered as cost only, because tomorrow when there is any declaration of dividend related to the period which before your acquisition, you have to deduct it from the cost only. You should not classify as a income. Okay, so if you are acquiring an investment for cash, if you are acquiring the investment through exchange with another asset, then the fair value of the asset given up, like I mentioned in PP and inventory. So if you exchanging an asset with another asset, if you are acquiring investment by giving up any other asset, then fair value of the asset given up is the cost. If you issue your own securities and buy investments, the fair value of the securities issued will be considered as the cost of the investment. This is of the cost. So whatever is the cost, you compare that cost with the fair value of the investment. If it is the current investment, if fair value is less than the cost, then you have to measure it at fair value. So what is fair value? The amount for which an asset could be exchanged between a knowledgeable willing buyer and a knowledgeable willing seller in an arm's length transaction. Okay, so the amount for which an asset could be exchanged between a knowledgeable willing buyer and a knowledgeable willing seller in an arm's length transaction will be considered as a fair value. So what is this fair value? The best evidence is market value. Okay, so how do you calculate fair value? You take a transaction between two parties. One of them will be buyer, one of them will be seller. The amount that is exchanged between these two parties, they are both knowledgeable, both willing to enter into the transaction, and it's an arm's length transaction. So the value that is exchanged between these two will be considered as fair value. So for this purpose, generally market value will be considered as a fair value. So market value for mostly investment for shares or debentures will be very easily available. So we can take that market value as a basis and calculate the fair value. So when you talk about current investments, measure this cost versus fair value. Fair value is less, then investments are impaired. The reduction in value will be transferred to P&L. Next year, if you find that fair value is exceeding the cost, whatever reduction you have done in the previous year will be reversed. That is one point. When it comes to long-term investments, we generally don't consider the reduction in fair value. We mostly value the long-term investment at cost only. But when there is a decline in the value of the investment, which is not a temporary decline, so which is a permanent decline. So there is a reduction value of the investment. If you have invested in equity shares of a company, and you feel the reduction in the value is permanent, it will not be going up, the value is reduced permanently, then you need to account for that reduction and transfer that as an expense to P&L. In case in future you feel that reduction is reversed because of some exceptional circumstance, you can reverse that one. So this applies to all the investments. So when you have investments in subsidiaries, which generally is in long term in nature, the subsidiary is incurring losses and there is no way which you can recover the investment, you can take that hit and consider that as a decline. When you have investment property, that means you invested in land or building that is not for use in the business, not for producing goods or services, but for giving for rental or capital appreciation. We don't classify it as a PPE, we classify it as investment property in the financials. But when it comes to measurement of the investment property, we follow the cost model, which is taken from AS10. Just now I mentioned how do we calculate cost model. So similar manner, we measure the cost model, we calculate the depreciation also. We calculate the depreciation. So there's no difference in how we measure it, but there's a difference in classification, because PP is not PP is held for production of goods or services for administration purpose. But for investment property, you have land and building, which is held for rental or capital appreciation, then you must classify as investment property. So when you look at the financial statements of a company, if they have any land and building, the next question we need to ask them whether they are using that asset for business or for rental or for capital appreciations. If you have a rental income in the books, that means they are using that for as investment property, you must classify that investment as investment property. Suppose there's no rental, uh, there's no rental income, only thing is capital appreciation. You need to check whether if they have any land, idle land, which is bought by the company, and their intention is to not to construct any factory building or not to construct an office building, their intention is to sell the land in future, then it must be classified as investment property only. Okay, so whatever is the classification of investment, whatever is the classification of investment, if you find the difference between on the disposal of investment, when you're whether you have current investments or long-term investment, when you dispose the investment, when you sell the investment, the difference between the carrying amount and the sale proceeds will be considered as a gain or loss in P&L, whether it's current investment, whether it's a long-term investment. Suppose you have number of investments in similar instrument. You have invested in equity shares of a company. Suppose you have invested 100 shares, you sold 20 shares. So you need to only recognize the gain or loss related to the 20 shares. How do I allocate the cost? The standard says you allocate based on average carrying amount. So if you apply AS2, in AS2, if you look at AS2, I mentioned FIFO weighted average is available, but when it comes to investments, the standard says you apply average cost only, not weighted average. So it is weighted average. We don't apply FIFO method, we apply weighted average method here. So that is what I mentioned. Now next question comes, what if I intend to invest in current investment, but I decided to not to sell it, I want to hold it for many years? Or if I acquire any asset with the intention of not to sell, but my intention is changed, I don't want to hold it, I want to sell it in the near future. So there will be reclassification. You can reclassify any item measured under long-term investment to current investment, any current to long-term. So how do you do the reclassification? At the date of change, on the date of change, if you have any long-term investment and you want to now measure under as a current investment, at the date of change, you take the lower of cost on the carrying amount. Mostly cost will be either equal to carrying amount or carrying amount will be less than the cost. So lower of cost and carrying amount, that amount will be converted into current investment and you measure accordingly. If you have a current investment and you want to transfer to long-term investment, You take the lower of cost and fair value on the date of transfer. On the date of transfer, you measure them at lower of cost and fair value. Then you transfer to long-term investment. That is what mentioned as per reclassification principle. When it comes to disclosures, you need to disclose the accounting policy measure followed for determining the carrying amount. Then how much amount you recognize in P&L as a gain or loss on disposal, or interest income, dividend income, rental income. Whether any significant restrictions on ownership, on disposal of investments, you need to mention those points. Or you might have taken mortgage, if they might have taken loan against these investments, so that loan should be mentioned here. If you have quoted investment, listed company investments, you need to mention the total amount of quoted investments, aggregate amount of total invest, aggregate amount of quoted investments, aggregate amount of unquoted investments. Okay, so what about stock in trade? So I mentioned AS13 is not applicable because investment definition is not covered, not covering stock in trade. But entities which deal in stock in trade means their regular purchase and sale of shares, debentures, daily basis. They follow principle similar to current investment. So they measure current investment means they measure it at lower of cost or market price, lower of cost or fair value. But when it comes to allocation of cost towards investments, they can follow first in first out and average cost both, because the standard is not applicable. They follow generally either first in first out or average cost. But when you don't have any stock in trade, you have normal investment, you apply weighted average only. So that is one difference. Okay, so when it comes to schedule 3 disclosures, now we need to be a little bit careful about disclosures in schedule 3 as per Companies Act. There is some difference here. See, if you look at schedule 3 classifies assets as current or non-current based on the realization of asset. So today, if you want to realize the asset immediately, your intention is to realize the asset immediately, then it will be current. If your intention is to not to realize immediately, then it will be non-current. So there is a basic difference between schedule 3 classification company and AS13 classification. AS13 classification is based on the date of investment. Today date is June 15. So today, if you bought any investment, from today your intention is to not to sell within 1 year, then it will be a long-term investment because your intention is to hold this. But when you prepare the financial statements on March 31st 2023, that moment it can be current investment for schedule 3 purpose, but as per AS13 it can be still long-term investment. For schedule 3 it will be on the balance sheet date. What is the expected date of settlement? What is the expected date of settlement? Suppose if your expected date of settlement is more than 1 year, then it will be non-current investment as per schedule 3. But if your expected date of settlement of this asset, of this investment is less than 1 year, then it will be current investment. But if you apply AS13 principle, it will be still long-term investment only, because we classify them as based on the balance sheet date. So AS13 requires classification based on the date of investment and intention of the management. Schedule 3 requires classification on the balance sheet date based on the realization, when you are going to expect the cash flow from the company, from the asset, cash flow from the asset. So mostly all current investments will be current as per schedule 3. So if you apply AS13 principles for current investment, both are same. We'll classify current as per AS13 and current as per schedule 3. Both will be same. But when it comes to long-term investment, for example, you invested in a bond, 1,000 rupees maturing in 3 years. Suppose if they're paying within 1 year some 300 rupees, second year 300 rupees, remaining amount third year. On the date of investment, it will be a long-term investment as per AS13. Even after 1 year also it will be long-term investment, because your intention is to not to sell in the market, your intention is to hold till maturity. But when it comes to balance sheet classification as per schedule 3, any amount which you're going to expect to be realized within 12 months will be considered as a current portion. So in balance sheet, one investment can be classified as non-current, can also be classified as current. The amount will be split between current and non-current. So it is not just all long-term investment will go to non-current. Long-term investment can also go to current as per balance sheet only, but it's still, as per AS13 classification, it will be still a long-term investment. So this is one basic difference between Schedule 3 and there is no no violation of AS13 or Schedule 3. Both are as per their own principles. If you follow correctly, we are complying with both AS13 and Schedule 3. Apart from that, Schedule 3 also mentions all your non-current investments should be classified as trade investments or other investments. AS13 is silent on what is trade investment. Even Schedule 3 is also silent on trade investment. So ICA has defined in the guidance note related to Schedule 3 what is a trade investment. So it also did not define it. It just mentioned normally understood as investment made by a company in shares or debentures of another company to promote its trade or business. So if you invest in if you invest in investments, equity shares of a company, of a subsidiary, suppose, the idea is to promote your own business. That's why you're investing in that company. It may be subsidiary, it may be outside entity also. But if the idea is to promote your own business, for example, you are investing in a supplier, you invested in supplier of your company, you are manufacturing a product, supplier is supplying one component, you invested in the equity shares of that supplier. So that investment may be trade investment. It's not a stock in trade, it's a trade investment, means it's a business related investment. If you if you invest in any other non-business, you will classify it as a other investment. So this is as per Schedule 3 only. As per AS13, it is silent, but in Schedule 3, we have to classify investment as trade or non-trade for non-current investment. Okay, so this is about Schedule 3, disclosure related to investments. This is also about AS13. Okay, so far we have covered investments, PPE and inventory. Now I'll talk about intangible assets, AS26. Okay, so when it comes to issues related to intangible assets, we might face some problem in relation to recognition of asset, whether it's an asset or not. Either it is acquired assets or internally generated, we might face some problem whether it's an asset or not. Then we face problem related to how to measure the carrying amount of the investment. Then we face problem related to how to measure amortization of the asset. Scope. When it comes to scope, there are some intangible assets if they are covered by any other standard, like leases. So if you have any lease of a intellectual property, then it may be considered as a leasing standard, not as per AS26. You need to be careful in deciding whether it is AS26 or AS19. If you have investment in financial assets, so it is also in the nature of intangible asset only, but financial assets generally not considered as intangible. They're out of the scope of this standard. If you have any rights, leasing rights, mineral rights, rights to explore and evaluation of minerals, those rights will not be considered as an intangible asset as per this standard. We apply general principle, not in this standard. Intangible asset from insurance entities we don't consider. If you incur any expenditure related to termination benefit, there may be some kind of intangible assets, maybe in the nature of intangible, but we don't consider them. Okay, so what is intangible asset? So it's an identifiable non-monetary asset without physical substance. The basic difference between PPE and intangible asset is PPE is a tangible, we can see them, we can touch them, but in case of intangible, we cannot see, we cannot touch, we can only feel them. But both of them are used for production or supply of goods or services, for rental to others, for administrating purposes. So if you have any intangible asset without physical substance, then it will be considered asset only. So the basic difference is intangible assets should be identifiable. In case of physical assets, we can see them, we can identify them, but in case of intangible, we cannot directly see them. So but still we need to identify intangible assets. So how do you identify intangible asset? You need to identify it separately from goodwill, distinguished from goodwill. So goodwill is an intangible asset, but we don't consider them as a separate intangible asset. Goodwill is the overall asset for a company, but for intangible asset, we need to identify them separately from goodwill. If you're not able to identify from goodwill, it will be part of goodwill only. So I'll come on this point. So how do you distinguish from goodwill? The major point is separable. So for example, you have an asset. If you want to sell the asset, or if you want to use the asset without disturbing other assets, then it will be intangible asset. If you want to sell that asset, you cannot sell them alone. You have to sell entire business. That means that is a goodwill. So goodwill cannot be used separately. It cannot be rented. It cannot be sold separately. If you want to sell goodwill, you have to sell the entire business. But when it comes to intangible assets other than goodwill, if you want to sell them, you can only sell that part without disturbing other assets. So this is how you need to differentiate between goodwill and intangible assets. So software, you can sell the software. It's an intangible asset. Or if you have any intellectual property rights, it can be sold separately without disturbing the business. But when it comes to goodwill, you have to sell the entire business. That is how you need to differentiate between intangible asset and the goodwill. So if that asset is used for production or supply of goods or service, then we classify them as intangible asset. And also we need to check whether we have control over the intangible asset or not. Only when you have control, then we can classify it as intangible asset. So how do you define control? Control normally comes from legal rights. If you have any licenses, you apply for rights from the government gives you right, so you can control that license by either selling it or by through legal rules. But if you generate any intangible asset internally, there may not be some rights, legal rights available to you, so it is very difficult to establish control. So the point is you need to establish control. So what do you mean by control? You can use that asset, you can use the asset as you wish. You can use it for generating future economic benefits, or you can sell that particular asset. So normally legal rights give you control, but without legal rights it is very difficult to establish control. This is, you need to be careful on this point. Okay, so applying the same principles as in AS10, when will you recognize intangible asset in the books? When it is probable that future benefits attributable to the asset will flow to the entity and the cost can be measured reliably. So an intangible asset initially will be measured at cost. So the same principles as per PPE. So for intangible assets, if you are acquiring them separately, so if you acquire computer software, if you acquire any legal right, intellectual property rights, you need to measure the cost. What is the cost? Cost is the price paid, purchase price. If you have any import duties or non-refundable taxes, you can consider that. Also, any directly attributable expenditure on making the asset ready for its intended use, like if you use any employees in purchasing that asset or in developing some part, some component, or if you incur any professional fees taking advice related to the acquisition. So all those will be considered as the cost for acquiring the asset. If same principle, if you're exchanging intangible asset with another asset, maybe physical asset, maybe intangible asset, so you need to measure at the cost of the cost is the fair value of asset given up. So same principles which I mentioned in PPE. Sometimes you acquire some intangible asset during amalgamation. So when you acquire any other company, you can recognize some assets which are not there in the books of the other company. So when you acquire or when you amalgamate with another company, so you can recognize intangible asset which is not recognized in the books of other company. So you can acquire separately through separate acquisition or through acquiring another company, you can recognize both intangible assets. Then there is internally generated intangible assets, which is developed internally. So for this standard, we need to classify the internally generated intangible assets into two phases. One is research phase and another is development phase. The principle is no asset arises in research phase. In development phase, you can capitalize the cost incurred as an asset, provided some conditions are satisfied. So what is generally research phase? It's an original or planned investigation undertaken. So when you start a new activity, new product, when you want to develop a new product, so any activities that you incur, any cost that you incur in that related to that activity is considered research. So no asset arises from research phase because you don't know whether the project is successful or not. So no intangible asset from research phase. All the expenditure incurred in research phase should be treated as expense and transferred to P&L. But when it comes to development phase, this is the phase where you got the some new product coming up from the process. So development is the application of research finding or other knowledge to a plan or design for the production of new improved products. So you have done some research, it is successful, now you want to develop that process. For this you incur some cost, that cost can be capitalized. So any cost related to development phase, see the actual technical details mostly goes to a technical person, so they have to define whether it's a research phase or development phase. We need to have some kind of idea about what is development. So whenever already some process is done, they're trying to improve the product. So if there is anything related to improvement of existing product, it can consider as a development phase. But if at all any new product is coming up, then we mostly consider as research phase. Unless the product is successful, then you want to capitalize that. So development phase, you can capitalize the cost provided these conditions, 6 conditions are satisfied. First is technical feasibility. So here we include people from technical background, computer software or engineers, professionals. So they will do the technical analysis and see whether this product is technically viable or not, whether you are able to generate whatever asset you are generating, whether it will create a new product, whether that can be used technically viable or not, whether it's not obsolete, should be having some market value, that technical feasibility. Then intention to complete, management must have intention to complete the project and create a new product, create a new technology, new process. And ability to use or sell the asset. Once the asset is developed, whether you are able to use the asset or not, what is your ability, whether you have the sufficient employees, sufficient capacity, sufficient resources, financial resources to use the asset or not. Then by using the asset, whether you are able to generate future economic benefits, so whether you can create a new sales from this, whether you will get cash flow from this, or you can use this new technology for reduction of the cost of material, cost of finished goods which you're generating. So it should create some kind of future economic benefits. All these are based on estimations only. Then availability of technical, financial and other resources to complete the development. You have financial resources or not, you have technical resources or not. Then you should be able to measure the expenditure. So measuring expenditure incurred is also important, because the amount of capitalization depends on the measurement. How much amount you expense, that much can be capitalized. So you need to know how much you spent or not. So what is the, so if you're able to satisfy the 6 conditions, then you need to capitalize the intangible assets. So what cost you can consider? Expenditure on materials, if you use any materials related to development phase, or if you employ people, the salary is paid, or if you use any other asset, that depreciation or amortization, or if you pay a legal fees to government to get a right, that is also considered. So overheads, allocation of overheads. If you borrow loans, it can be considered if the asset satisfies definition of qualifying asset. So we can consider this cost as a cost of internally generated intangible assets. Some cost we cannot consider. What are those costs? Selling and administration cost, similar to PPE. Initial operating losses before the asset achieves planned performance. Expenditure on training the staff. So if you train the staff to work on a new software, to work on a new project, so if you're giving any training to employees, the training cost cannot be capitalized. The training cost will go to P&L only. So these are not intangible assets. So what are not intangible assets? Even though it satisfies these conditions, the standard specifically mentioned that you cannot capitalize internally generated intangible assets if it is related to brand value, or if it is related to masthead or publishing title. So in newspaper you have the title. So anything related to name, anything related to brand cannot be capitalized internally. If you acquiring them outside, then you can capitalize them, but if you generate them internally, you cannot capitalize them because it is considered as the internally generated goodwill. Even internally generated goodwill cannot be capitalized as per the standard. So customer list also cannot be capitalized because it is very difficult to measure the value and we don't know whether it will generate future benefits or not. But if you acquire customer list or brand or master from outside from any other entity, then you can capitalize, but internally generated you cannot capitalize. Also, some of the expenses which you incur cannot be capitalized, like expenditure on startup activities. So when you're incorporating a company or doing some activities, you pay some professional fees. So all those things, expenditure on startup activities cannot be considered as intangible assets. It should be written off. Expenditure on training activities, expenditure on advertising, all this should not be capitalized, should be transferred to P&L as expense only. Expenditure on relocating and reorganization of enterprise, part of an enterprise. So relocation expenses also cannot be capitalized. All this should be considered as expense only. What about the past cost? See, I mentioned that research phase, any cost incurred in research phase should be transferred to P&L as expense only. In development phase, we can capitalize provided the conditions are satisfied. So initially you thought it's not a viable product. So whatever expenditure you incurred, even in development phase also, you might have transferred to P&L as an expense during interim period. Like you're preparing financials for 6 months, September. You thought that is not going to make any sense in capitalizing asset. That asset is not valuable. So you written off the expenditure. At the year end, you came to know that you have done a mistake, that this is an asset, this should be capitalized, but you have already transferred everything to P&L. So whether in this current year, in the interim periods, or in the previous year, any expenditure which should have been capitalized, if it's already been treated as expense, you cannot reverse that expense and you cannot capitalize the asset because it will be treated as a goodwill again. This expense related to goodwill. So any expenditure already expense should not be reversed. You cannot reverse it. Okay, that is about the expenditure incurred. What about if you already capitalize an asset as an intangible asset, subsequently you incur any expenditure on that asset? How do you consider that? Any subsequent expenditure should be treated as expense only. You should not capitalize it unless it is probable that expenditure will enable the asset to generate future economic benefits in excess of its originally assessed standard of performance. So what the standard is saying, you already capitalized intangible asset. Now you're incurring further expenditure to improve the asset. If it is only maintaining the same capacity even after incurring the expenditure, you cannot capitalize it, you treat it as expense. Only if there is an increase in performance of the asset, then only you can capitalize it. And this happens in rare cases. So all the time subsequent expenditure will be transferred as expense only. Okay, so once you create any asset in the books, now you need to apply cost model. You need to apply you need to measure it subsequently also. So there's only one model available in the standard, that is cost model. If you go to Ind AS, we have same two models like cost or revaluation model, but in AS 26 still it is not updated with the relevant IFRS or Ind AS. So we are still following only cost model. The cost model says you have to amortize the asset. If there's an impairment, you need to consider the impairment. So what is the amortization? So for the amortization unit, useful life, you need residual value, just like depreciation. Then you need to select the method. So useful life mentioned in AS 26 is maximum 10 years. So you can capitalize the asset and amortize it only for maximum 10 years, unless you justify a longer period. Suppose you have a license to operate a telecom company. Suppose the license life is say 15 years. You can consider the license as intangible asset and amortize for 15 years, provided you need to justify that the asset will generate benefits for 15 years. So maximum 10 years. So we are conservative here. I've seen many companies following intangible asset like software, uh, depreciation amortizing for 3 years only. So it is okay within 10 years limit. So method is straight line method, usually straight line method. No other method is mentioned. If you want, you can follow a different method, but because intangible assets will be generally more used equally over life, so we follow straight line method. And residual value is assumed to be 0. So there will be no residual value. For intangible asset, we need to keep residual value as 0 only, unless there is a commitment by a third party. So if there is any commitment to purchase the asset at the end of the life, which generally doesn't happen, or there is an active market for the asset, which may not be available. So most of the time residual value for intangible asset is 0. Then you calculate the method, straight line method, then you calculate the amortization. Again, we need to review the method selected on the useful life. All method and useful life, both we need to review, and we need to useful life, and even the residual value is most of the time assumed to be 0. So you don't have to review it annually. So if the expected life is different from the previous estimates, you need to change the life, and you need to accordingly, you need to consider it as a change in estimation and apply it prospectively. So here also you need to review annually amortization period and the method. So method mostly straight line method, so there won't be much change in the method also. So if at all anything happens, it will be with useful life. So derecognition, same principles as PPE. When you dispose the asset, you need to remove it from the financial statements, from the books. Or if there is no future benefits from the use or sale of the asset, you need to derecognize it. If the asset is held from active use, if the asset is retired from active use, you need to measure it at carrying amount till the date of disposal. Okay, no further amortization. Or if you feel that there is no benefits, then you immediately remove the from the books. If you feel there is some benefit available, you by selling the asset you get some income, then only you consider carrying the asset till it is disposed. If you feel there is no benefits, you need to remove it from the books. Then disclosures. The useful lives or amortization rate used or amortization method used, you need to consider them. Then gross carrying amount and accumulated amortization. So just like PP, whatever we give, same disclosures will be given here. Schedule 3, it has given the list of classification of intangible assets like goodwill, brands or trademarks, computer software, masthead and publishing titles, mining rights, copyrights and patents, recipe, formulae, models, license and franchise. So this is related to Schedule 3. So this is related to Schedule 3. Okay, next. So we have covered AS2, 10, 13 and 26. So A16 is a general standard related to all the assets. So whether we can capitalize borrowing cost or not. So it's a very pretty simple standard, but some principles are there we need to check. So what is the objective? The objective of the standard is to prescribe the treatment for borrowing cost, whether we should capitalize borrowing cost or whether we should consider it as expense or not. So it doesn't deal with actual cost or imputed cost of owner's equity. So including preference share capital, not classified as liability. So if you classify preference share capital as a liability, or if you calculate preference share capital or equity shares, sometimes owners calculate the cost of equity. So for general investment performance purpose, so cost of equity will not be considered as a borrowing cost as per the standard. Don't consider cost of equity as a borrowing cost. Other than that, if you classify anything as a liability and if you pay any interest, then we consider that as a borrowing cost. So the principle of the standard, what is the principle? Any borrowing cost that you incur which are related to directly attributable to acquisition, construction or production of a qualifying asset should be capitalized. So borrowing cost related to acquisition, construction or production of a qualifying asset. For other borrowing cost, you should consider it as an expense. So what is the qualifying asset? We need to focus now. And what are the borrowing cost? See, borrowing cost generally interest that you incur. So you incur other costs like processing fees. So interest and commitment charges on bank borrowings and other short-term borrowings, amortization or discounts related to borrowings. So if you issue debentures on discount or if you issue them on premium, so any amortization related to the discount also will be considered as borrowing cost. Amortization of ancillary cost incurred in connection with arrangement of borrowing. So if you incur any cost related to borrowing, cost related if you're issuing a debentures, you incur some cost related to issue of debentures, printing cost, prospectus cost, printing of prospectus. So you might pay some commission to agents. So all those will be considered as a borrowing cost only. In case of assets acquired under finance lease, finance charges that you're paying is also a borrowing cost. And also finally, if you borrow any loans in foreign currency, to the extent they are regarded as an adjustment to interest cost. Like for example, if you have any foreign currency borrowing, why we go for foreign currency borrowing? Because the interest rates in the dollars in US or UK is less than India, right? So if suppose India rate is 10%, there you might be getting at 5% to 6%. So there'll be huge gap between interest rates. So you might borrow that. But one risk you are facing by borrowing foreign currency is the loans in foreign currency is the foreign currency rate changes. So if the rate changes, that rate changes might be affecting you badly. You might be paying more than the interest which is paid in India. So forex loss related to borrowings. So how we calculate? To the extent regarded as the borrowing adjustment to interest cost. So how do we consider this? Whatever loan you borrowed in dollars, suppose if you borrowed in India, how much you would have paid interest? You need to calculate that amount. By borrowing in dollars, you are paying less interest, but you might be facing risk in foreign currency exchange rate. So to that extent of exchange rate, which is affecting you, so you need to calculate both interest plus exchange rate related to borrowings, related to foreign currency borrowings. So calculate what is the interest you're paying, calculate the forex loss which you're incurring from the foreign currency borrowing, compare with the India interest rate. So to that extent of India interest rate, whatever is the foreign currency gain or loss, you need to consider it as a part of borrowing cost only. We don't classify them as a loss related to foreign exchange. I would like to give an example, but since time not permitting, so you have to calculate what amount you are paying in India. If you are borrowed in India, how much you would have paid in India, how much you are paying actually in foreign currency borrowings. So to that extent of total interest paid in India, you need to consider the exchange rates exchange differences also as interest cost only, as a borrowing cost only. Okay, so this is about borrowing cost. Then qualifying asset. So what is a qualifying asset? Any asset which takes substantial period of time to get ready for its intended use or sale. Like you are developing manufacturing plants or power generation facility. Even inventories can be considered as qualifying asset if they take a substantial period of time to bring them to saleable condition. Investment properties are also considered as qualifying asset. So inventories which take substantial period of time also will be considered as qualifying asset. Okay, so a qualifying asset is asset that takes substantial period of time. So what is a substantial period of time? Generally, it depends on case to case, but standard assumes that 12 months is a basis for substantial period of time. But you can justify that less than 12 months is also a substantial period of time, or more than 12 months also can be considered as substantial period of time, depending on asset, depending on the nature of the asset. So which are not qualifying asset? Inventory that are routinely manufactured are not qualifying assets, and assets which are already ready for use when they're acquired. If you constructed a building, that means it takes substantial period of time. But if you purchase a building which is already ready for use, then you don't consider as a qualifying asset. So if you have qualifying assets, then if you have any specific borrowing related to the qualifying asset, all the specific borrowings related to the time which takes substantial period of time to get ready for its intended use, all the interest related to that period will be capitalized. So in case of specific borrowings, directly we take the interest incurred from the date of borrowing till the date of construction is completed. We take that interest as a cost of the asset. But if it is a general borrowing, then we have to calculate a capitalization rate. We take weighted average borrowing rate, weighted average cost of capital, cost of borrowings, cost of debt, weighted average cost of debt. That rate will be considered, and we multiply that rate with the expenditure incurred on the qualifying asset. So whatever is the resulting amount will be considered as a borrowing cost, which to be capitalized. Remaining borrowing cost will be considered as an expense only. So when will you actually start commencing capitalization of borrowing cost? So three things. First, you need to borrow the loan. You need to incur expenditure on the asset. Then you need to do some activities necessary to prepare the asset for its intended use. Just like that, if you are borrowing the loan, it doesn't mean you have to start capitalizing it. You have to actually incur the asset expenditure on the asset, and you need to do continuously the activities on the asset. Then only you need to commence capitalization. Sometimes you have to suspend this when you're not doing any construction activity or development activity. You will stop temporarily capitalization. Then permanent cessation, that means once the asset is ready for use, any borrowing cost incurred after that period will be not be capitalized. So when substantially all the activities that are necessary to prepare the asset is complete, so when you complete all the activities 95%, 98%, then you can stop capitalizing it. Okay, so when it comes to disclosure, you need to disclose the policy that you are adopting. So policy is that you are capitalizing the borrowing cost related to qualifying assets. Other borrowing costs are considered as expense only. How much amount you have capitalized during the year should be mentioned in the notes. There's no specific disclosure from the Companies Act Schedule 3. So mostly we need to refer to AS 16 only. So that is related to the topics which we need to cover today. So we have covered. So we have covered AS2, 10, 13, 26, and 16. So all these are assets related standards. So basically the principles remain same, whether inventory or property, plant and equipment, or investment or intangible assets. We need to measure initially at cost, and subsequently if it is inventory, we measure that cost or NRV. If it is PP, we follow either cost model or revaluation model. Investments, we classify them as current or long term. Long term investment mostly as cost, current investment at cost or fair value. Intangible assets similar to PPE, only we follow cost model. We amortize the intangible asset. Borrowing cost, we capitalize only if it is related to qualifying asset. So that is what session for today. So if you have any doubts, you can now you can ask now. Hello, Ringesh sir. Is there any questions from audience?
Uh, Hi. Hello, CA Praveen. No, I don't see any questions as of now.
Okay.
So I guess thank you so much, CA Praveen Naga. That was indeed
Okay.
a very brief and deep learning on the assets, its valuation, and related transactions, and of course the accounting standards relating to these assets. I'm sure this will be really helpful for our day-to-day accounting and financial statements and in our day-to-day profession. Thank you very much for brief detail and learning. I also
Sure.
thank WIRC for organizing this learningful lecture, and thanks for all for joining and being a part of this.
Sure. Thank you very much for participating.
Thank you everyone, and thank you all the participants for being a part of this learning lecture.
Okay. Thank you.
Thank you so much.